Financial stability is often treated as a personal trait. In that view, a household is stable because it budgets carefully and avoids excess. The system is assumed to be stable when enough households behave that way. Yet the current data present a contradiction. Employment remains firm and consumer spending continues, but many households report strain. Payroll growth has not collapsed, and aggregate consumption remains positive. If income is supported by employment and spending remains active, stability should follow. But the arithmetic of required payments tells a different story. In late 2025, owning the median-priced home required more than 40% of median household income. That exceeds the long-standing 30% affordability benchmark used in housing policy. When the median household cannot clear the median payment, stability cannot be explained by behavior alone. The issue is structural. Households live inside contracts that set recurring obligations. Rent renews at a new rate. Insurance premiums reprice. Mortgage payments are fixed by the interest rate at origination. Financial stability is therefore a capacity condition. It is defined by the margin between income and fixed obligations. If required payments rise faster than earnings, the margin narrows even in a steady labor market. The mechanism becomes clearer when price level is separated from inflation rate. Inflation can slow while the higher price level remains embedded in monthly bills. In early 2026, shelter prices were still rising year over year, while real wage growth remained modest. Insurance costs were increasing even faster than overall consumer prices. Insurance reinforces the same floor. When rent and insurance rise together, required payments increase even if headline inflation cools. These are recurring contractual costs. They are not discretionary adjustments. This is the fixed cost ratchet. A ratchet is an increase embedded in recurring contracts that is difficult to reverse. Households can reduce discretionary purchases, but they rarely renegotiate repriced premiums or refinance into materially lower mortgage payments when rates remain elevated. Housing makes the ratchet measurable because it combines prices and interest rates into one payment. Before the pandemic, owning the median home absorbed roughly 30% of median income. By late 2025, that share had moved well above 40%. That ratio shift represents a structural change in entry conditions. Contract exposure. Differentiation explains why strain varies across households. Borrowers who locked in mortgages at lower rates carry different obligations than those signing contracts today. The same employment data support both groups, but their payment burdens differ. Slower home price appreciation does not restore affordability when the payment remains elevated. Even if price growth moderates, the financing structure remains tighter than in prior years. Aggregate indicators can appear calm. The Federal Reserve's household debt service ratio remains far below levels seen before the financial crisis. Many outstanding mortgages were originated at lower rates, keeping averages contained. But averages reflect legacy contracts. New contracts reflect current rates and prices. Stability at the margin can deteriorate while aggregate ratios remain stable. Once required payments rise, the secondary pressure becomes margin compression. Margin compression is the narrowing of the buffer between income and obligations. Employment can remain stable while savings decline. In late 2025, the personal saving rate was under 4%. Real disposable income growth had slowed. When income growth stalls and required payments remain high, resilience declines. Margin compression affects financing behavior. Total consumer credit outstanding has continued to expand, with revolving balances forming a meaningful share of that total. Balance sheets expand as households bridge payment gaps. Rate transmission amplifies this process. Credit card interest rates remain near historic highs, hovering around 21% in recent quarters. When revolving balances carry rates near that level, the cost of smoothing rises quickly. As buffers narrow and balances rise, fragility threshold testing begins. This is not systemic collapse. It is the gradual testing of limits as more households operate close to required payment thresholds. Total household debt has reached record levels, and the share of debt in some stage of delinquency has risen modestly from prior quarters. Serious delinquency transitions have increased for credit cards and mortgages, with stress more visible in lower-income areas and regions where home prices have softened. A thinner equity cushion meets a higher payment in those regions. Employment alone does not offset that ratio shift. The transmission path continues into the credit layer. Rising revolving balances increase bank receivables. Persistent rental demand sustains shelter costs. Household payment pressure becomes institutional exposure. In the banking layer, funding and margins matter. Bank credit and total assets remain elevated. Net interest margins have stabilized near recent historical averages. Deposits have grown more slowly, and funding has become more rate-sensitive. Liquidity erosion can occur even without deposit flight. Funding costs can rise, while balances remain steady. Stable deposits do not guarantee stable margins. Institutional ratio. Drift follows when assets and liabilities reprice at different speeds. Margins determine how much stress can be absorbed without curtailing credit. If funding costs rise faster than asset yields adjust, lending standards can tighten. At the policy layer, the Federal Open Market Committee has maintained a restrictive federal funds target range. Mortgage rates have eased modestly from recent peaks but remain elevated relative to the pre-pandemic period. Policy transmission layering means new borrowing adjusts quickly while existing contracts adjust slowly. Households entering new contracts feel the change immediately. Those in older contracts feel it only when renewal or refinancing occurs. The dominant pressure remains the fixed cost ratchet in housing and insurance. Secondary pressure appears as margin compression in household cash flow. Tertiary pressure appears as fragility threshold testing across income groups and regions. The stage is escalating. Employment remains firm and consumption continues. Yet required payments absorb a larger share of income, savings remain low, and revolving balances expand. Financial stability is not defined by the absence of recession headlines. It is defined by the durability of margins across households. When the ratio of income to obligation narrows, stability becomes conditional even in a steady labor market. Financial stability is a structural condition.